The Treasury is getting ready to get out of Citi. The government said today it plans to sell its 7.7 billion shares of Citigroup this year, and that is welcome news to our next guest. Christopher Kotowski is a managing director and analyst at Oppenheimer Co. He joins us now from his firm in New York with his reaction and outlook. Chris, welcome to Bloomberg News. Always good to have you on.
Thank you. Thank you for having me.
Chris, how big a deal is this?
Well, it's a very important move. It's the government should be out of the banking business, and they know it, and they want to be out, and so I'm glad it's finally happened. In general, you know, we're pretty positive on bank stocks over the next 2-3 years, and I'm sure the people who buy from the government will ultimately do well on this as well.
Right.
But I guess just maybe a little bit of revisionist history, but you know, I kind of, from my view as a taxpayer, I wish that the government had sold some of these shares before they forced Citi to do this very dilutive recapitalization in December.
Why is that, Chris?
Well, I think we as taxpayers would have gotten a much better deal on it. And you know, what ended up happening is that by demanding that Citibank redeem the second phase of the TARP preferreds first, while keeping its common shares still there, it limited the pool of potential investors. And that's why you had this disastrous offering in December, which drove the stock down to $3.15. And by my calculations, ended up, you know, causing about a billion to 2 billion shares more to be issued than needed to be.
Chris, is the market willing to absorb the stock?
Oh, I think they'll absorb it, but it's going to be here for a while. If they stay in that parameters of 8 to 10% of the daily average trading volume, it would take somewhere, by my calculations, it'll be between 30 and 40 weeks to clean up this block.
Are institutional investors ready to jump back into the deep end of the pool? They've been sitting on the side of the pool with their toes in the water for a while now.
You know, I think in general, the numbers we're seeing out of the banks point you to a general industry recovery. And bank investors are getting back into bank stocks. And I think, again, most banks, I think 2 or 3 years from now, will look back. The recovery will have occurred by then. And so investors are, you know, clearly beginning to bid up bank stocks. And Citi will benefit. It wouldn't be my favorite in the group, but Citi will benefit along with others.
What would be your favorite in the group?
The favorite in the 3 stocks I'm recommending are JP Morgan, Wells Fargo, and Bank of America.
So do we see the big money centers normalizing now?
Well, we're beginning to see the inflows of problem assets stabilize.
Well, can they stand, let me put it another way, can they stand on their own without a government lifeline?
Oh, absolutely. I think, you know, right now, I think a recovery is largely, it's highly probable, and I think only really an exogenous shock, you know, another oil shock or something like that would get you into a you know, negative spiral again.
Chris, earlier today, Anton Schutz of Menden Capital told our John Ehrlichman that demand for Citigroup warrants, which were not a part of today's announcement, demand for the warrants will be decent. Is that a fair assessment?
I heard his comments, and he's right that the demand for all the other ones has been fairly robust. The one thing you should keep in mind, though, I think the price on those warrants is $13.88, and there's 30 billion shares outstanding. So for those warrants to be in the money, Citibank would have to have a market capitalization in excess of $400 billion, which is, it's kind of like, you know, JP Morgan and Google put together, and more, you know, I mean, it's, when you have 30 billion shares outstanding, it's harder to move the needle. But that said, there will probably be demand for those too.
Chris, about 30 seconds left. I don't mean to throw you a curve, but it is more of a political question. Is this vindication for Treasury Secretary Geithner and the TARP program?
Well, I think the way he structured the equity infusions in last February was genius, because what it did was it put a floor on the stocks, so the market could realize that they could raise capital at some level. And that's what I think was the beginning of the end of the crisis. And I wrote that last March, and we called it the beginning of the end of the crisis. And I think that part of the program, I think Geithner handled beautifully.
Chris Kotowski joining us from Oppenheimer today. Chris, always good to get your perspective. Thank you so much. We appreciate it.
Thank you.